What's coming will be far worse than the 2008 financial crisis. In a recent piece titled "Policymakers May Create a Recession Worse Than the 2008 Crisis," the United Nations expressed concern. It asserts that unless adjustments are made to monetary and fiscal policies, the global economy would continue to stagnate and inflation will continue. Regardless, you will be far better able to survive the recession than the typical person if you are ready when these kinds of signs arrive and can weather the storm of difficult economic times. One of the biggest and most well-known banks in the world, Credit Suisse, has also issued a warning in addition to the ones from the UN. It seems likely that they will soon run out of money based on what they have revealed. Depending on the choices they make, their long-term stability and sustainability may be in danger. Concerning the global economic crisis, the UN issued a strong warning, predicting that rising interest rates will lead to a cascade of debts, healthcare problems, and environmental problems in developing economies. Additionally, they claim that we risk losing productivity of roughly $17 trillion and that our economy is headed back to pre-COVID levels. The United Nations is criticizing central banks for seeking to stifle growth through unexpectedly high interest rates that have made life much more difficult for individuals who are already struggling with significant debts, despite the fact that these occurrences coincide with the recession. They assert that there is a global debt crisis because so many countries, organizations, and people are heavily indebted and rely on historically low interest rates. We now have to pay the expenses of inflation and record low interest rates that have been in place for the previous 14 years as we seek to stabilize interest rates. Additionally, it's contributing to a global recession and stagflation that might worsen climate change and human health, as well as significantly affect our economy and population. Debt is a significant issue that needs to be handled as well. It is estimated that 30% of emerging markets and 60% of low-income countries are on the verge of financial difficulties. They are pleading with governments and financial organizations not to raise interest rates, since doing so will have disastrous consequences, given that the majority of the world is already in debt. Let's return to Credit Suisse now. Despite having previously experienced debt problems, they are not alerting others to the current debt catastrophe. To give some context, a string of disastrous purchases by Credit Suisse led to a major issue. They used loans to finance a portion of their investments in failing hedge funds. They used failing loans to pay for the riskier investments, which resulted in insolvency and a substantial loss. Investors started dumping their Credit Suisse shares after suffering significant losses. As a result, over the past 5 years, the value of Credit Suisse shares has decreased by more than 70%. They've also disclosed plans to raise money by issuing further debt and perhaps even stocks. Due to Credit Suisse's string of bad investment choices, the cost of debt servicing is rising, necessitating more debt payments. Then, what does this mean for Credit Suisse? The CEO of Credit Suisse assured shareholders in a statement that despite marketing volatility and credit default swaps, the company has a strong capital basis and enough of liquidity. Credit default swaps were a key factor in the 2008 financial crisis, as you will recall if you think back on the circumstances. Credit default swaps were merely a type of insurance. These swaps thereby provided investors with protection during the 2008 financial crisis from the possible failure of a financial institution or a mortgage. Additionally, credit default swaps involving Credit Suisse have increased recently. People have started purchasing insurance against Credit Suisse out of concern that the company will fail due to a shortage of capital. But Credit Suisse has said something pretty odd regarding their present attempts to get more money. Despite its assurances that it has no liquidity or financial problems, Credit Suisse has come under fire for its intentions to increase debt and sell more shares in order to raise money at a lower and diluted share price. In other words, they are indicating that they are prepared to reduce the value of shares in order to increase their overall profit. They also made a statement in response to the concerns that many investors could have about the bank's need for capital if solvency was not a problem. The underlying goal, according to Credit Suisse, was to alter people's unfavorable perceptions of investors. In order to reassure investors that they are still turning a profit and have enough cash on hand, Credit Suisse claims that they need to raise capital rather than because of problems with their finances or worries about their solvency. Let's move on to the United States, where there are 1.1 million fewer job vacancies in August than there were in July. However, when interest rates rise, more people are beginning to experience the effects of inflation. Stagflation may be to blame for the recession's early phases. Does this imply that since more individuals have work, more jobs are being filled and the employment prospects for the few remaining are improved? Or businesses are reluctant to bring on new employees while the economy is still weak? Different responses and interpretations have been given to this study. Some people have hypothesized that this might mean there are more people working, while others conjecture it might mean more people are finding jobs or that businesses are reducing hiring. The Federal Reserve Bank examines a number of items, including this. They do a thorough and transparent analysis of the job report. In more detail, the number of roles available, as there were previously 2 job postings for every candidate, a rather high ratio. Less job posts per candidate was one of the ways the Federal Reserve Bank attempted to control the labor market. They claimed that the labor market was too tight and that there needed to be more layoffs. They similarly cited this as justification for continuing to raise interest rates. The most recent employment report indicates that there are now 1.67 open vacancies for each candidate. Although somewhat high, the Fed may use this as additional evidence to support the claim that we can still successfully combat inflation with the resources we now have at our disposal. Because inflation is damaging the economy, the world, people, and investments, corporations, the UN, as well as some investors think that the Fed should cease fighting it so vehemently. Despite this, inflation is still at all-time highs. Since then, many people have questioned what the Fed is trying to accomplish. Do we want to go through an economic catastrophe and currency collapse? There is a decision the Federal Reserve System must make. Which is worse, the high cost of the current recession or the prospective cost of a currency crisis brought on by high inflation in the future? The Federal Reserve Bank must choose between these 2 options before its meeting in the first week of November. As a result, you should think carefully about this. When you decide that you want to be the person that takes advantage of the opportunities that are offered to them is one such time. Investing in markets, stocks, real estate, commodities, and even cryptocurrencies are all examples of seeking for opportunities. You can benefit from the decline in asset values and buy something if you have the money and the knowledge to do so. The next element of your financial position that you need to pay attention to is your income after you've learned how to handle and manage your money. You must focus on improving your financial security since the last thing you want to do is live in poverty for the rest of your life. You don't want to do that for the rest of your life, even as you make an effort to live within your means.